In a crisis, gold moves, governments try to move faster because whoever holds the gold holds control. The Bank of Canada holds zero gold, not a single ounce in reserve. That means that if confidence in the currency slips or the financial system hits turbulence, the government has no hard asset buffer of its own. Gold and silver in any form is monetary at its base. So once you become clear that the true fundamental value of an ounce of gold at this moment, before more money printing, is somewhere between $38,000 and $40,000, and the true fundamental value of an ounce of silver before they do anything else is somewhere between $1,800 and $2,000.
In the middle of growing monetary instability, financial analyst Lynette Zang outlines why gold historically rises to prominence during systemic crises. Her core argument is simple. When trust in fiat currencies begins to erode, governments move quickly, because control of gold often translates into control of monetary influence. Nations with limited gold reserves could face greater vulnerability if financial confidence weakens. As global debt levels climb and central banks continue aggressive monetary policies, she emphasizes that gold and silver remain foundational monetary assets. Unlike paper currency, they cannot be printed or digitally created at will. From her valuation perspective, if modern currencies were realistically backed by tangible assets, gold could potentially justify prices in the $30,000 to $40,000 range, with silver possibly reaching $1,500 to $2,000 over time. Her outlook is based on the idea of a monetary reset, where declining purchasing power forces a large-scale repricing of hard assets. In that kind of environment, precious metals wouldn't just trend upward slowly, they could adjust sharply as confidence shifts away from fiat systems. If this breakdown added value, consider liking, sharing, and subscribing to stay updated on gold, silver, and broader monetary trends. Now, let's move into the interview.
I can't say that confiscation is happening. And again, Canada has never overtly confiscated gold or silver. But structurally, the pressure increases when the state has none and citizens have plenty. And I want you to just remember that the transition that we're in right now, that reset from this one system into the new system, well, we've never really gone through this before. This is different than when we went through the transition from a gold standard to a debt standard in 1971, because they need to reinvigorate the entire fiat currency system. And what they really have to do is they have to do that overnight revaluation, because gold is the most trusted collateral without any counterparty risk. So keep it in mind. And you know, I mean, it has been happening here in the U.S. for a very long time. Having said that, I want to let everybody know that at this point in time, we are not legally obligated to report any part of the transaction. This would be true on American Eagles. It's 100% true on the collectibles. So just keep that in mind here in the U.S. But what do they want to do? They want to digitize everything so that it could be used for collateral and they could track everything, the buys and the sells. This is why we have to come together on a global basis and demand our rights back. Because otherwise, we're slaves. That's it. We're slaves. You have to ask yourself, is that okay with me? If it is, don't worry about it. If it's not, then come together and let's get redeemable gold back in the system. It's not that gold is going up, it's the value of the dollar going down, and gold and silver in any form will hold your purchasing power intact. It's the way that you hold it and the variety of ways that you can hold it. So the strategy isn't switching mints or crossing borders. It's stepping into forms of metals that give you insulation, privacy, and control, no matter what jurisdiction you're standing in. And remember, silver is the fuse. It straddles both worlds, so it's a lot more volatile. But this trader, he's not reacting to physical silver. These physical markets, they just do not move that fast. He's reacting to the paper market, a leverage contract stacked so high that they're swaying. That's what we're seeing right now. It's really so interesting. And you know, when one big domino tips over, it doesn't fall alone. This shows you what happens when the pressure spreads from a single trader to an entire government's central counterparty intervention. They had to, because it threatened the entire very fragile paper system. It's political weight, because when a government steps in, especially one as large and influential as China, it means that the position is big enough and the leverage is heavy enough that it threatens total stability in all the markets. This isn't about ounces of silver. It's about those contracts.
In this in-depth macro conversation, Lynette Zang outlines the deeper structural weaknesses developing within the global monetary system and why gold and silver remain critical in the next financial shift. She notes that while asset confiscation is not currently happening, pressure historically rises when governments hold limited hard assets and citizens accumulate tangible wealth. As the global economy gradually moves away from a purely debt-driven fiat model toward an uncertain new structure, gold's importance as trusted collateral, free from counterparty risk, becomes more significant. She discusses the possibility of a sudden revaluation event, where gold could play a role in stabilizing or restructuring weakened currencies. Unlike the 1971 departure from the gold standard, today's potential transition may focus on restoring credibility to an over-leveraged financial system. Meanwhile, the rapid digitization of money introduces concerns about increased surveillance, centralized control, and reduced financial privacy. Zhang also points to vulnerabilities within highly leveraged paper markets, particularly in silver. Price volatility often reflects stress within derivatives and contract exposure rather than true shifts in physical supply. When leverage threatens broader stability, government-level intervention can become a real possibility.
This is huge because, again, once a government intervenes in a short position, it tells you that the paper side has grown too large relative to the real metal underneath. Now the dominoes, they're leaning harder and they're leaning faster. And frankly, they're leaning in one direction. So let me show you, because once political weight hits the line, well, then what is it? The next domino begins to lean, and that's the gold contracts. Let's look at how that paper market is tilting the biggest piece in the chain. Let's see. Oh, spot gold. This is a spot gold contract. Okay. What I also want to show you in here are the technical moves, because on 2/6 we were at 49. So I just did this. What's today? Today's the 10th. Okay, so this is, I pulled from Friday, and you can see that big, huge correction. Now, I want to remind you, first of all, that the distance from that 50-day moving average that we've been talking about now for quite some time is 9.45. 10% is a lot, so it's still a lot away above that 50-day moving average. But the 200-day moving average is still 37.38% away. That is extreme. That is showing a massive divergence from its long-term trend. It's not spot gold drifting higher. It's tilting, it's leaning far above that 200-day moving average. And that kind of move doesn't come from the physical part of the buying, though we are, and I cannot wait until it's complete, but it's not complete yet.
In this market update, attention turns to an important warning signal. When authorities step in around heavily leveraged short positions, it can indicate that paper exposure has grown far larger than the actual physical metal supporting it. That kind of imbalance is significant. When derivatives and contract volume expand far beyond available supply, pressure can ripple quickly through connected markets. Recent price action in spot gold adds to the picture. Even after a notable pullback, gold continues to trade well above major long-term indicators, especially the 200-day moving average. A gap that wide from long-term trends often points to structural forces at work rather than routine physical demand. Moves of this scale typically reflect broader macro drivers: currency stress, leverage buildup, and institutional positioning, shaping price behavior. The bigger message here isn't about day-to-day volatility. It's about the growing disconnect between paper contracts and tangible assets, and what could happen if that gap stretches too far.